So let's look at this chart of Caterpillar. So this is again a 2-year chart. It's a weekly chart. So each one of these bars represent 1 week's worth of data. And Caterpillar, again, you can see from the beginning of this year, along with the S&P 500, it's gone up nicely. But sometime in the middle of February, Caterpillar's upward climb stalled. And for some reason, Caterpillar started coming down. And if you didn't know what was going on with the company, you would just be looking at the charts just like we are doing right now. So I don't know what happened, but at some time in late Feb or early March, Caterpillar turned around. And it looks like, if you just look at this chart now, that Caterpillar is on a downward trend. Now, it did come out with earnings last week, and it seems like the earnings were pretty good, $2.37, which was better than last quarter at $2.32. However, the market's not too thrilled with it, and Caterpillar is still on its way down. If you wanted to optimize this move on Caterpillar, what would you do? You know that first of all, the overall S&P environment is on an uptrend. Then you know that going against the S&P is in general not a very good idea. Now you also know that Caterpillar is in the business of providing heavy machinery and things like that. So a lot of the infrastructure spending, or a lot of all the economic activity that happens in the economy directly affects Caterpillar. And we can see some things are slowing down in the economy. So you want to optimize a bearish move, but what would you do? Would you buy a put option in this case, or would you sell a call option in this case? So you could buy, I guess, a 95 strike put, and you would give it enough time, perhaps a couple of months, so that this move can be optimized a little bit. Even if Caterpillar falls from where it is today, it's at 101. If it falls to about 95, your put would make a lot of money. Or the other option is you put probability on your side and sell a call over here at around the level of $120. So here you have to look at the risk and reward factors also. Now you know that the S&P is on an uptrend, and Caterpillar is a bellwether of the S&P 500. So for some reason, Caterpillar now has lost its correlation in the last few weeks to the S&P 500. There could very well be valid reasons for this. I just don't know what they are right now. I haven't looked it up. I haven't read anything about Caterpillar. But you know the S&P trend is up, and you know that Caterpillar is a bellwether of the S&P 500. If for any reason at any time Caterpillar takes a turnaround and starts to move up along with the S&P 500, it shouldn't come as a surprise to us that it would do that. So in this case, and if it did that, and if it turned around and went upwards, if you sold a call position at 115 or 120, that call position, that short position on the call might get into a little more of a trouble, because now you have much more risks on selling the option than if you were to buy a $95 option, a $95 put option. So in this case, it looks like the better strategy might be to buy a put option around 95 or 100 and see if we can optimize a slight move to the downside. And if we find enough profits there, we can close out our long put position and keep the profit. If on the other hand, it turns around and moves up along with the S&P, because this is a trade that is going against the tide. The S&P is on a trend upwards, but Caterpillar is not. So even though you're taking a bearish trade on Caterpillar, which makes sense if you just look at the Caterpillar chart, but if you look at where the overall S&P is, you would be going against the trend, because I'm pretty sure Caterpillar also has at least a 1 beta. We'll see what the beta is. So, in this case, you wouldn't sell the call option, because that would be taking a bit of a risk, because if Caterpillar turns around, then your short option is going to be in trouble. Much better would be to buy a 95 strike price put option and see how that plays out. So let's see how that will play out. And that's exactly what we're looking at. This is Caterpillar. Current price is about $101. And we can see that it has a beta of 1.1. So it's very closely correlated to the S&P 500. But we've seen in the last couple of months, it has not been in correlation. It has been going against the S&P, so it's not been correlating very well in the recent past. But that can change. So we need to be concerned that that can change. So what we do is, let's go look at our options. So we're looking at the June series, and then we were thinking about the 95 put. So that would be this option. We are going to pay 1.56 to 1.57. That's a very close bid-ask spread. You can't get any better than that. And if we go to the June series, we're going to pay that. Let's just quickly look at the July series as well. Oh, the July series has not yet opened up. The next series is August, and the 95 put on the August would be about $3.95. So that's quite a bit more than what we want. So the August series won't work for us. Let's go back to our June series, and you look at this put option at the 95 strike price. Even if you were buying, say, 10 contracts, which is 1,000 shares on Caterpillar, you would only be paying 1.57 for this option. So that would be a total of, they'd hold a margin of about 1462. But let's just quickly look at its risk profile. And there you go. So it's Caterpillar's at 101 today. If it continues to go down for the next 1 week, say you can make a profit of, even if it goes down by $3-4, you're making a profit of $1,000. So on a capital investment of $1,500, you could potentially pocket almost 60% of that in profits. And you don't have to wait for a long move. If you hit your profit target, you would come out of this trade and close it out. Now, if you were to sell a call option, let's just go and see what we would do. We wouldn't sell the 95 call because that would be in the money. Let's go see if we sell a 115. I think we were looking at 115. And if we were looking at the 115 strike price, this is what selling the call option would do in terms of our risk graph. You can see that our maximum profit here is only $230, but then we are exposed to unlimited losses. So selling a call option just does not make sense in this case. And what you would do if you wanted to optimize Caterpillar was just go into the put option side and just buy a put, because looks like its current trend is down. And if it continues for the next couple of weeks, we should be able to pocket about 60 to 70% return on our investment, and we come out of that trade at that time. So that's as far as optimizing your position looks like. So if you want to go bullish or if you want to go bearish, you have two options on each side. Remember that. You can do it two different ways. You can either go long an option or you can go short an option. So if your outlook was bullish, you can go long call or short put. And if your outlook is bearish, you can go long put or a short call. So there are pluses and minuses of both of these. When you go long, the pluses is your losses are limited, but time decay is going to be against you. So you want to give yourself enough time. You want to see how long this kind of a move might take to play out. And if you're unsure, then you're better off probably selling a call option or selling a put option. But again, you have to look at the individual situation. You look at what the overall market is doing. What is the overall market sentiment? What are the levels of volatility? So again, volatility is an issue that we need to cover. If the environment is that of a very high volatility environment, then you may be better off selling some options, because whenever volatility is high, remember, option prices are going to be higher. And so you could get a lot more premium for the same strike price when you sell a call or a put option. But think of when the volatility will be high. We know that volatility is high when there is uncertainty in the markets, or when there is a crash going on, or when there is a crisis brewing. So when volatility is high, you have to keep that in mind. It's high for a reason. And so you have to be careful, especially if you're selling a put. Let's say you go way out of the money and sell a put. You'll get nice premiums even if you go way out of the money on the put side. You can in fact go a lot out of the money and still get a decent premium. But what happens if it still crashes? If it goes further down, then volatility will continue to increase, and that's going to hurt your short put position. So you might in some ways be better off by buying a long put, because then you can optimize the downward move. Or when volatility is very high, your call option premiums are also going to be high. So it may be a good time to sell a call option because even those premiums are going to be higher, but now you're selling a call. So if the market continues to go down, then selling a call would have made a lot of sense because you got a lot more premium because the volatility environment is high, your short strike price is not getting hit, and if the market continues to go down, then your call option will be profitable. On the other hand, if the market turns around and starts to go up, then volatility will be coming down. So the premium that you received was a high volatility premium. And if volatility starts going down because the stock or the market turned around and went up, then you could profit from your volatility position. And we'll look at all these Greeks and the Vega and all of that. We are going to do a deep dive and you'll see how all of this works out. So this is how you would optimize your strategy. You would pick an optimal option position that is best suited for your outlook at that time. So we've reached the end of this course. Hopefully you've gotten a good idea of how to select your strategy. You put the bigger market picture into place, then select your stock, and then you select the option, you select the expiry series, and finally you have to select the ideal option also. You have 4 choices. You have 2 choices for a bullish outlook, and you have 2 choices for a bearish outlook. And therefore, you must make your choice, which one it is. And that, as you understand your positions, as you put the whole market perspective into context, you will probably realize that one of the 2 will be the right choice. And you go with that choice. Remember, if you're selling options, always put probability on your side. And if you're buying options, you need to give yourself time so that time decay doesn't hurt you.